The great irony right now is that the more bad news we have about the economy, the better the actual long-term outlook becomes, and the quicker we could start to anticipate that interest rates will fall and we can get back to some sense of stability in the new normal of the new Toronto real estate market. And I think many people are looking forward to that. Talking about great bad news, according to Stats Canada, they just came out with their recent GDP print, and it shows that for Q3, the economy actually contracted. And this surprised a lot of people and economists and probably the Bank of Canada itself. It contracted by 1.7%. So this essentially seals the deal that the Bank of Canada will not be raising interest rates at their upcoming meeting on December 6th. Furthermore, it really stems the question not if we are at the end of the cycle, but when we can expect to start to see interest rates coming down and what impact that could have on the Toronto real estate market in 2024. Today, we're also going to discuss, is the federal Liberal government and essentially most politicians in the media demonization of Airbnb and investors going to have a helpful impact at bringing back affordability? We're also going to look at, as of December 1st, the rollout of open bids in Ontario and how important that will be in terms of bringing back affordability, or what impact at all that's going to have on the market. We're going to talk about the outlook of inflation and interest rates, and has the market actually bottomed out, which is a big question right now on buyers and sellers' minds, and a lot more. So please be sure to stay tuned. My name is Ralph Fox. I am the broker of record and co-founder of Fox Marin, and we are a boutique real estate brokerage that focuses right here on central and downtown Toronto. Please be sure to hit that subscribe button. And if you have any constructive comments, we would absolutely love to hear from you. And don't forget to like that like button as well. Okay, so let's get into it. Let's talk about the recent federal Liberal government's budget. They singled out Airbnb specifically in the budget. And their approach to Airbnb is to try and help open up more affordability by opening up supply, by bringing about further restrictions on Airbnb landlords, in the hopes that all of a sudden we're going to have affordability now that there's newer restrictions put on Airbnb hosts. So if you are an Airbnb investor operator, as a result of the new budget, you are not going to be able to deduct any of your expenses off your rental properties anymore if you are renting out in restricted municipalities. So you're not going to be able to write off your mortgage interest or any of the costs that go with running the property. I think the thing to keep in mind here is that in a major city like Toronto, which I think this is really aimed at, you have to keep in mind that there already are significant restrictions on Airbnb here, where you can't rent out short-term any property unless it's your principal primary residence. And even more so, most condo buildings in Toronto really just don't allow for short-term rentals. So it's interesting because Christina Freeland, who's the finance minister, came out, and basically what she said was she felt that this new act by the government is going to open up 30,000 units to the market, either on long-term rentals or more supply coming out. And I really don't see, if you take into consideration that most people who are renting in Toronto, short-term Airbnb, landlords, it's their principal residence. Either they're away for a period of time or they're renting out rooms, or that if you're in a condo, which is the majority of investors, you can't even rent out in the majority of condo buildings in the city. I really don't think that this is going to play much of a dent. I do think that there's a trend line here in vilifying short-term rentals, vilifying landlords, and vilifying investors. But at the end of the day, this isn't really going to have much of an impact. And if you look at the statements that are coming from Airbnb in response to this new budget, what they're saying is that they view their service really as a way to help with affordability for homeowners who are trying to keep up with increasing costs. There's a lot to read into this, but I think that at the end of the day, this is really just more of another soundbite by the federal Liberal government trying to put some type of another Band-Aid solution on the deeper issues, which is supply and increasing housing costs due to inflation and high interest rates. So not really much to go into here other than I think this is just another nothing burger put out by the Liberal government. This is one of the things that I talk a lot about and think a lot about very deeply is really how this demonization of investors by politicians and the media is only going to continue to exacerbate the housing affordability crisis. There was this great article in the Globe and Mail, and it talks about how in 2022 there was a study, a very well-known study put out by the CMHC, and basically, it reported that Canada will need to actually produce 3.5 million more housing units than we currently have in the delivery pipeline by 2030. Let me repeat this. Canada will need to produce 3.5 million more housing units than are currently in the pipeline, delivery pipeline, by 2030. So this really brings to mind two questions. Question number one is, where will those 3.5 million families live, and how much will they have to pay for a home? And what prices will look like in Toronto in that type of a scenario? Well, the answer is a lot more expensive than they are today. So if you look at the CMHC's target number of 3.5 million new homes, that literally means that we will need to conjure out of thin air $2 trillion to pay for all of these new homes. And to put that into perspective right now, Ottawa has only $82 billion put aside for housing over the next 10 years. And to put this even in greater perspective, if you took the total pension fund assets in Canada, that roughly totals about $2.1 trillion. So we need a lot more money, and a lot more money than the government has put aside or is even capable of putting aside, to even come close to hitting that number put out by the CMHC, which just is a baseline affordability number. And so, this demonization of capital required for the housing market and the financialization and the commoditization of housing, it's really great for sound bites and vote grabbing in terms of populist talk, but at the end of the day, it's really not based in fact, and it's not going to be helpful in any way if we're going to come close to creating and building the housing that we're going to require. And in this article in the Globe and Mail, it talks about a very well-known book in the planning world called Selling Paris. And that was written by a Harvard University professor, Alexia Yates. And there's a quote from the book, which was highlighted in this article, where it states that the people, practices, and politics that spurred the largest building boom of the 19th century, turning city making into big business in the French capital. And she describes the way that housing for property became commodities during this crucial period of French urbanization. And this is really, really important to take a look at, because we use Paris as the greatest example, either by city planners around the world today, or any type of romance novel or any movie that you see depicted of a great urban city. It's always Paris. And people always talk about Paris as this incredible, vibrant, well-constructed city. And yet, if you look at how it was actually built and when it was built and who built it, it really starts to sort of open your mind up to what is possible when you engage the private sector in the appropriate way. And you look at, the way people talk about Paris's high density and the bike lanes and pedestrian and transit-friendly transport systems and the boulevards, without really ever talking about how they built it and the contribution of private business and developers to building Paris during that very crucial period. So I think that's something really interesting that this article talks about. And it really goes back to what we were saying a little earlier about needing all of this capital and private money that's going to be required if we're going to come close to bringing any type of cohesive planning in our cities. And so, and certainly hitting those markers in terms of bringing the supply to where we need it to be. And so, we really have to remind ourselves that any home, any residential home, be it a rental home, be it a home where someone lives, either they're renting it from an investor, it was definitely built by a developer. And if they own the property and they own their own residence, then they are homeowners themselves and they've invested into their own property. So investment is such an important thing. And I think once we start to demonize it, it's really only going to start to continue to hurt which is what we need most, which is supply. And we don't need a contraction of supply. We need a massive, massive amount of new supply to come online. And so, if you want to look at some interesting stats here, in the 1970s, our population of Canada was 22 million people, and we built at that time 220,000 homes. In 2022, the population was at 39 million, so it almost doubled. And yet we built the same amount of homes, 220,000 homes. So that is really significant because it shows that there's a real problem with the amount of building that we have going on, and it's just not keeping up with the amount of population growth and immigration that we're experiencing in Canada. And further to that, if you look at the 35 OECD countries, Canada actually ranks second last in terms of the time it takes to approve a building permit. We actually are behind the Slovak Republic at the very bottom of that list. And if you look at, countries like the UK or you look at countries like the US, they actually will approve building permits 3 times faster than we do in Canada. So we have a lot of structural problems with our building and the way we encourage properties from developers to be built. It's incredibly slow, it's incredibly expensive, and I think we need to open up and speed up that process, and we need to really encourage more investment, more development into cities like Toronto and not less. There was some other recent news that came out by StatsCan that showed that in October, the CPI rose by 3.1%. Now, this is down from September's numbers of 3.8%. So this was in line with what economists were expecting, but it was really nice to see that drop in conjunction with the report coming from StatsCan that indicated GDP contracted by 1.7% in Q3. Pretty much seals the deal as we were talking about earlier. And now there's almost 100% consensus that at the next Bank of Canada meeting on December 6th, the bank will be holding or pausing once again. In a newsletter that I'm on from Douglas Porter, who's the chief economist from Bank of Montreal, from BMO, in his newsletter, he states that essentially in a mere matter of weeks, the narrative has gone from higher for longer to rate cuts are imminent. So that's really interesting to see this shift happening, as it really looks like it's not even a question of if we're in a recession, but the fact that we are in a recession. And now it's more about, is this going to be a hard or soft landing? And obviously the jury is still out on that one. But talking about imminent rate cuts, it's really important to understand that 50% of mortgages haven't seen an increase yet. And over the next 18 months, there's going to be a tremendous rollover in the other 50% of mortgages that haven't seen that increase. And that's totaling about $1 trillion plus that's going to be rolling over. And so there's a lot of economists and banks that are talking about the Bank of Canada needing to get ahead of this. Not so much in that I think you're going to see a huge amount of foreclosures, because we've seen banks are willing to extend amortizations and work with homeowners and investors. But I think what you'll see is a greater contraction of discretionary spending, which is already obviously happening as we're seeing inflation come down and we're seeing GDP come down in conjunction with that. And so really recession at this point isn't really a forecast, it's a reality. And depending upon how you look at it, we really are in a recession. And we've talked about this in past discussions, but GDP has now been flat or negative for 3 consecutive quarters. But even really more important than GDP is real GDP per capita, because our GDP has been masked with this massive population growth that we've had of 1 million people. 2.7% of our population is growing annually, and that's been masking our GDP growth. But when you look at on a per capita basis over the last 7 quarters, it's been negative, and year over year, we're down about 1.7%. If you look at all of the data, I think it's really obvious to conclude that we are now in a recession, and I think that discussion is now beyond it. And we're really now moving into the discussion of, okay, well, now that we're here, what next? And what we're seeing is, and this is, I've been talking about this, I've seen other economists, David Rosenberg, talking about this, but it really drives me nuts in that when we talk about inflation, we're really not really looking at it from a fair perspective, because 31% right now, mortgage carrying costs have gone up over the course of the last year. And that's been a massive, massive driver of how we calculate inflation. So if you minus out the shelter costs, we're at about 1.9%. We're under the Bank of Canada's target rate. And that's really relative because if you look at where we were, if you took the cost of shelter out of the CPI equation prior to the pandemic, we were at about 2.1%. So obviously, with 500 basis points of increase of interest rates, that's going to affect that cost of shelter. But you take that out, and our inflation is actually lower than it was prior to the pandemic. So inflation has really, really come down. And I don't really think that they are really looking at it from a proper perspective. And this is something I've been saying for a very long time. And if you going back to David Rosenberg, if you look at what he's been talking about lately, is he's been talking about the debt to income ratio now hitting 170. And we've seen those levels before in Canada, but that's when interest rates were at, next to 0 or 1%. He's been talking a lot about how the fact that if you're at these 170 debt to income ratios, 15% plus of your income is servicing all of your debt. It becomes very, very, very unsustainable. And the only times we've seen these highs were in the 2007 and 2008 recession. And it looks like really that is where we're heading to. And at these debt levels with interest rates where they're at, it's really the equivalent of interest rates being at 13, 14%, which really, really, really is not sustainable long term. And knowing that all of these mortgages are about to roll over, he's really calling for significant reductions in 2024 between 200 to 300 basis points by the Bank of Canada. And so I don't know whether you believe it's going to be 200 to 300 basis points or 50 to 100 or 75 or 25, but the narrative really has shifted over the last couple of weeks. The winds are blowing, and it really seems like, the discussion is not if rates are going to come down. It's really a question of how much. Another thing that I wanted to talk about today is open bidding. So there's been a lot of discussion in the media and by politicians about having open bidding versus closed bidding offer nights, which is much more common in Toronto, especially in the more traditional sellers market that we experience here predominantly most of the time, except for probably the last couple months. But I'm sure we'll be going back to that time period sooner rather than later. And we still do have a lot of multiple bid offer scenarios where they are blind bidding. And so there's been a lot of discussion about this topic. And one of the things we've talked about on this channel is how that really doesn't bring back affordability. If you look at Australia and New Zealand, where they have complete wide open bidding, almost like auctions, prices are rising and are as equally, if not more expensive there than they are here. So it's not the solution that a lot of real estate pundits or politicians or the media expands it to be. However, it is something that is now an option as of December 1 here in Ontario. So prior to December 1, we were working under the old REBA, Real Estate Business and Brokers Act. We now have TRESA. And as part of TRESA's rollout as of December 1, there is now the opportunity for open bidding. Now, this really isn't going to do much. And if anything, it's going to create more of a mess in terms of how these offer nights are held and how multiple offer scenarios are carried out. So let's walk through this. So under TRESA now, sellers have no requirement to disclose details, and they can literally pick and choose what they want to disclose. And so what I mean by is they can, if there's 5 offers on a property, they can say, let's just disclose nothing, or they could say, let's just disclose deposit or conditions and price. But the thing is that they can make up their minds about what they want to share. And then at the same time, they can then change their mind mid-process. That becomes a problem, especially if you're talking about affordability, because sometimes a seller could be in a position where all of a sudden they're like, we're not disclosing anything. And then you've got a few offers and they're all close. And then they disclose the price to all of the bidders. And then all of a sudden, now we start to see the prices trickling up in a very sort of competitive manner that we wouldn't have normally have seen or had the potential to see in a blind bidding scenario. So the balance shifts far more in favor of the sellers. However, buyers, in response to these new rules, now have the opportunity to put in a condition saying that if their price or any information of their offer gets disclosed, that their offer then becomes null and void. So then that puts them in a position where they can learn about all the other offers without disclosing any information on their own. So based on having the ability to exercise that condition or clause in an actual offer, I'm not sure how many scenarios we're going to see where there's open offers because somebody has the opportunity to have that advantage by putting that as a condition. And then further to all of this, now we have a scenario where sellers are choosing essentially what they want to include or not include and then changing their minds. And some buyers are having the ability to put in these null and void conditions upon disclosure of what's in their offer. There's no real system to track any of this. So it could come down to a he said, she said type of scenario, and there's no real dashboard or any way to ensure that from one agent to another agent, from one offer night to another offer night, that the information is being disclosed in the same manner. So this seems like a giant mess to me. And I think it's going to take a while to work itself out. And I wouldn't be surprised if over time these rules and guidelines become modified and more streamlined, because it seems like this is just going to make things even more of a mess when really what the intention obviously was behind to have greater transparency. So it'll be interesting to see how this plays out. And I look forward to seeing some offer nights later this week or this month and seeing how all of this plays out in multiple offer scenarios. It definitely will be interesting. But again, it's not going to help or bring back affordability, which is really seemingly where all the pressure is with trying to open up bids versus having a closed bid scenario. So in summation, don't expect any real changes in government policy or regulatory bodies to really impact the market itself. Expect rather that they will actually continue to hinder. And so the main driver of the market really, as we've been talking about, is going to be interest rates and the Bank of Canada, which itself is supposed to remain independent of the government and regulatory bodies. So, we could expect to see rates, according to some, come down a lot sooner and a lot more than the media and a lot of people are expecting. So that's going to be really interesting to watch. And I think the thing that, it's really important to remember is that the market in Toronto was a ripping last April and May. And at that point in time, the overnight lending rate was only 500 basis points less than it is today. So the question is are we at the bottom of the market? And that's really hard to say. And it's really impossible to time the market or even know that we're at the bottom of the market and be able to prove it until we're already on our way back up. But if you believe, like we do at Fox Marin, that we are ending or we are approaching the end of the interest rates hike cycle, then it would appear as though we might possibly be at the bottom. And based on what we've been seeing and feeling in the market over the last few weeks, it's starting to seem an awful lot like it. So will be interesting to see if that in fact is the case as things unfold over the next weeks and months. Most likely, we're expecting to see a winter with slow activity, but there definitely could be some pricing softness, especially in the condo sector over the next 3 to 6 months. However, looks like things could really start to pick up by the summer and especially going into the fall. So lots to watch. It's never a dull moment. Thank you so much for tuning in. Once again, my name is Ralph Fox, and this is Fox Marin. If you love or like or are mildly interested in our content here, please be sure to hit that subscribe button. And if you have any comments, we'd absolutely love to hear from you as long as it's constructive. Also, don't be shy to hit that like button. So thanks again so much for tuning in, and I look forward to seeing you next time.